Please welcome our first speaker to the stage, Dana Peterson.
Hi, everybody. Can you hear me? Awesome. Well, thanks so much for having me. It's really a pleasure. I'm going to talk about the global economy, the US economy, and then a little bit about this region. What's going on? What should we expect? How can we kind of power through what's headed next? So, all right, so there we are. That's me. Okay, here we go. So, this is what I'm going to talk about. So if you get this slide, you can fall asleep, check your emails and come back later. But essentially, the big mega trends are that we're looking at some recessions in some regions around the world. We're still having pandemic effects. Yes, the illness is still out there, but China is going to reopen, and that's going to have some implications not only for China, but for the entire world. We still have this war in Ukraine going on, which is affecting supply chains and food and energy. And with all that, we don't expect a global recession, but we could have, material slowdown in the US and Europe, maybe even recessions by, economic definition. Like I said, we still have supply chain disruptions, even though they've lessened considerably, but we still have a lot of inflation around the world. Central banks are raising interest rates in response to that to combat inflation, and that's causing these slowdowns among a number of economies. And then we still have demographic issues and repercussions from the pandemic itself that are affecting labor markets, causing massive labor shortages, not only in the US, but certainly also in Europe, Japan, China, and a number of other economies. What's ahead? Well, industrial policies are actually right here, and they're only going to get worse. That's essentially when governments tell businesses where they can situate their supply chains and their factories and who they can trade with. We are going to see slowing growth rates in terms of how quickly economies expand from year to year. We're going to see labor market contributions shrink, meaning fewer people, especially in the US and China, Japan, and Europe. But the good news, and I am going to end on a happy note, is that productivity is going to be a key source of growth for many economies, especially the US. And digital transformation and automation are going to be key components of that. So that's the good news. So don't get too depressed. Okay, you can all, go get some coffee. No, I'm kidding. Please stay with me. All right, so let's start off with what CEOs are thinking. The Conference Board is really great at conferences and surveys. So we do this survey of executives, CEOs and CHROs and CFOs from across the globe, and we ask them, what are your biggest existential concerns? And unsurprisingly, economic downturn or recession was really big in the top 5, or looks like the top 2, for the US, China, and Japan. There was also a lot of concern about labor shortages. In China, when we did the survey, it was like November, December, so they were still embroiled in the lockdowns. Now, lockdowns are gone, but is everybody going to get out there and spend? We don't know. But really big concern about growth, right? And then in terms of internal dynamics, what were businesses thinking? Well, you can see some common themes. So if you see 2 things in the same color, it means it's a common theme. So driving revenue / profits, growth, big issues. That should always be the issue for every company. But they're also having difficulty with respect to modifying their business models with changes internally as well as externally. But they're also really focused on accelerating the pace of digital transformation. So that's really great for any company, any business that's in technology, either in the services end or the components or the ideation, intellectual property aspect. So this is what companies are grappling with. This community has those solutions. So what's the global outlook? Well, how did we get here? We basically had a number of really big shocks. We had the pandemic, we had the global shutdown, we had energy price volatility, supply chain disruptions. Then we had another shock last year. We're right about the 1-year anniversary in a few days, plus a few days. The war in Ukraine, which not only caused a humanitarian crisis, but we've seen impacts on supply chains and disruptions of those supply chains in food, energy, metals, rare earths, chemicals, and fertilizers. And certainly the metals and the rare earths and rare gases, that's really critical because we need those materials to produce semiconductors and batteries, which are all going to be important for digital transformation and the almost inevitable transition from primary fossil fuels use towards renewables. But with those two big shocks, we've had tremendous amounts of inflation. At first, it was in commodities and transportation and goods because everyone was stuck at home. So they bought lawnmowers and televisions and pools and all that stuff. And they bought houses. Now we're shifting where people are into services, right? So going on vacation, going out to the movies, going to restaurants. And we're also seeing massive labor shortages that are causing an increase in wages, right? So all that inflation is showing up in your pockets. And central banks are trying to do their best by raising interest rates to curb inflation. But that means that we're going to be pushing some economies either into recession or to the brink of recession, which we think are going to be short and shallow, meaning not too long and not too bad. So here's just some pictures for those of you who like pictures. You can see that the supply chain pressures, this is a measure by the Federal Reserve Bank of New York, that really peaked already and it's come off. And that's on the left-hand side. Both the navy blue line and the light blue line shows that we've really improved in terms of supply chain disruptions, but there's still some out there, right? And indeed, when we look at in the US, the price, the producer price, or what businesses are paying for things like computer chips, it's still rising. So we still have these disruptions going on affecting inflation and business operations. So inflation, it's a global problem. Both advanced economies like the US and emerging markets like China are experiencing high inflation. The good news is it looks like we've reached the peak and it's starting to come off, but not very quickly. Inflation has been pretty sticky. And in response to that, as I mentioned, central banks have been tightening. So for those of you who like finance, their balance sheets, they're shrinking their balance sheets, right? So that's pulling in some of the liquidity that's out there. And they're also raising interest rates to cool off the desire for consumers to buy things and business, the desire to invest, right? And using debt as a measure as a means to do that. Industrial policies, as I mentioned, are already here. We're already seeing economies around the world, governments saying to businesses, well, you must reshore or onshore or shorten your supply chains or nearshore them, right? Build out local supply chains and wherever you are, or trade with friends, friend shoring, all these different types of shoring plus hoarding, like don't send computer chips to China or this to that country, right? And we're seeing that intensify. And the reasons why are varied. So national security, economic disruption. Certainly we saw during the pandemic economic disruption, or even denying access to technology or rare earths, for example. Even countries providing subsidies to certain industries, right, to increase their competitiveness, and even public health threats. And the key thing is that certainly in the United States and also in China is that the information and communication sector is a big target, one of the target areas for these industrial policies. So they're here, they're not going to get better in our view. So with all this, we think that there are going to be some economies that experience recession. So if you're light blue, you're probably going to have a recession or something very close to it, or at least something that feels like a recession. So that includes much of Europe, Eastern and parts of Western Europe, the United States, and that looks like Chile, Argentina, and Brazil. So these are our global growth projections. So last year we did okay. The global economy grew by 3.3%. That's about average, the long-term average. But for this year, we think we're going to slow to 2.3%. That's not a recession, right, in terms of how you define it, but it's not really that great, right, when you're used to growing at 3% or more. And you can see that the economies that are kind of weigh things down are going to be the US and the Euro area. So very nearly flat growth for this year with a few quarters of negative GDP growth that are going to feel or at least be recessions. Meanwhile, China is going to be one of the major drivers of growth. And that's because they're going to be recovering from 3 years of being in lockdown, right? So a lot of it's just people coming out of their homes and consuming services again. We already went through that in the US. Now China's going to go through that this year. But with all this bad news about growth, when we look at labor market measures, for example, unemployment rates, they're all really low. So labor markets are actually doing pretty well around the world. But a lot of that is because you just don't have enough workers. And so a lot of companies are not laying people off, they're hoarding labor. And there's some industries that are still trying to hire people who were let go during the pandemic. And even some of those industries within that are having difficulty doing so. So what are some regional outlooks? I'm just going to focus on the US and China, but let's start with China. So as I mentioned, China is going to be the biggest driver of growth this year globally. So that's what that chart on the left-hand side is showing us. You can see China has the biggest bar. There we go. That's the story, right? And the US and Euro area not really contributing much, if anything, to growth this year. But with that, there are some challenges for China. The biggest driver of growth for China is going to be the consumer, right? Or consumers who've been hit by a housing market decline in China, and they've lost a lot of wealth and also have been cooped up, and they have very low confidence. So the pink line on the right side, that's the consumer confidence measure. It fell off a cliff and it hasn't really improved. There is one more reading for December, and it ticked up a little bit, but it's still like towards the bottom. So we need consumers in China to feel really good about the economy, get out there and spend, right? So that's one challenge. The other challenge is that China is very connected globally. And you can see on the left-hand side that both their imports and exports growth has gone negative, right? So imports have gone negative because consumers, aren't out there buying things. But exports have gone negative because of slowing economic growth in the US and Europe, who are among China's biggest trading partners. And then you still have the housing market in China. It hasn't reached a bottom. It's continuing to weaken. And that is destroying wealth for consumers. And when consumers don't feel wealthy, they don't spend. But, China's still a great place to invest, because if we look at this chart, basically this is showing which economies over different decades have contributed to the most to growth. And over the next decade, China is going to be one of the biggest contributors to global GDP growth, along with India and other emerging economies, especially ASEAN economies. So Asia, in particular China, is still a great place to invest and focus on your business, but you are going to be challenged by those industrial policies. Okay, US, what's going on? So we all know that the Fed is raising interest rates very quickly. And if we take a look at the chart on the left-hand side, you can see that they've basically hiked interest rates by almost 5 percentage points in less than a year. And they're not finished. We think they're going to hike 3 more times by 1/4 of a percentage point. And that's really extraordinary, because if you look at the past 2 times that they've raised interest rates, it took them several years to finish what they were doing in order to get to a pinnacle. But they're doing this all very aggressively. And so we think that there are 3 more interest rate hikes this year, and then the Fed will hold rates steady for some time, and then maybe start thinking about cutting next year. So the light blue line on the left-hand side is our forecast, right? So all that to get inflation back to 2% target, maybe by the end of next year. So inflation is very sticky. It's going to take time to undo that big run-up that we saw last year. This is very colorful, but I mean, the key thing is, well, what is even driving inflation in the US? Well, 3 basic things. On the left-hand side, the yellow bars, you can see they're getting bigger and bigger and bigger. That's food. And food prices are determined outside of the US, but also within the US. But mainly, we're seeing food prices rise because of the war in Ukraine. Ukraine and Russia are some of the biggest producers and exporters of grain. And grain prices are not just determined locally, they're determined globally. So if there's a shortage, over there, it's going to hit the US over here. And then we also have the avian flu, and we've had flooding and droughts, all sorts of bad things happening, causing food prices to rise. And you probably read about it in terms of the cost of eggs. I saw we had eggs this morning. I was a little surprised, but also happy. But those are some expensive eggs. Okay. Now, in terms of services, you have that blue bar, that first blue bar, which keeps getting wider and wider. That's housing costs. And in these consumer inflation measures, it's rents. So rents reflect what happened in the housing market a year or more ago. So we know a year or more ago, the housing market was red hot, right? And prices just shot up. And so that's what we're seeing with rents with a big lag. Now home price valuations are coming off. We're not going to see that in the rents probably until the middle of this year. But for now, we're going to continue to see housing costs, which impact consumers, especially folks at the lower end of the income spectrum, being very negatively affected. Then all the other stuff, all those other colorful bars, that's services, things like restaurants and hotels and airline tickets. And that's all things that people want to engage in right now because they couldn't over the last 2.5, 3 years. So what does this recession look like in the US? Well, we think it's probably 3 quarters of negative GDP growth. It's not that bad, right? And it's not that long. But nonetheless, we're going to see some negative growth. You're probably asking me, well, you had some negative GDP growth last year. Weren't we in a recession in the first half of last year? My answer is no, because when you dig beneath GDP, it's made up of spending. What consumers spend, what businesses spend, what the government spends, and what foreign individuals and companies spend in the US, right? And also inventories. And we know inventories were very volatile as well as international trade last year. But when you peel away those two pieces, consumers are still spending a ton of money, businesses are still investing, right? So the red bars that we're expecting over the next few quarters mean that business and consumer spending are probably going to be a little negative, right? So that means domestic demand is not doing very well. Then you say to me, well, what about the labor market? Well, we think the unemployment rate's really not going to rise that much. Maybe right now it's at 3.4%, maybe it gets to 4.5%. That's roughly 900,000 job losses. So I don't want to be in that number, but it's really not that many, right? Compared to what happened during the pandemic when the unemployment rate jumped to 13.5%, and during the Great Recession when the unemployment rate jumped to 10%. You had millions upon millions of people being let go. We don't think that's going to happen this time. Why? Because many businesses are either still hiring, roughly 37% of CEOs say they're still hiring or plan to hire, or they're hoarding workers, meaning they're not letting people go. And the reasons why they're not letting people go is because they think this recession is not going to be very long. It's not going to be very deep, meaning very bad. And many companies still have, or they're still looking for workers. They still don't have enough people, right? So only 19% of CEOs are saying they're going to let people go. So that's good news, right? So don't worry about all this text. You'll get the deck later. But the reason why we're having labor shortages is because the baby boomers are retiring. That's great for them. Not so great for the labor market. And so if you look at this chart here, you can see back in the 80s and even in the 2000s, you had 4 working age people per every retired person. Since then, it's fallen to 3 people. And in 10 years, it's going to be 2 people. And beyond that, it's going to be, even fewer people, right? So baby boomers are leaving the labor market, and there's not an easy replacement, right? So that's why we have these labor shortages. And indeed, the labor shortages are the worst. All the stuff on those big bars, those are all industries where people physically have to show up to work. And a lot of them are in-person services, right? Where you have to go there or people have to physically work there. In information, which is where a lot of tech firms are, not so many labor shortages. Indeed, we're hearing bad news about people being let go. And indeed, here's data in terms of how many layoff announcements, not actuals, but just announcement saying we're going to let this number of people go. And it's really outsized in technology. But I have some good news. All right. Said I was going to end on a happy note. Everyone's like, oh my gosh, this woman. Okay. So the good news is when we look at all the tech sector jobs and we tried to add all the pieces up, you're still really well above the long-term average, which is that dotted line. And you're also way above where we were even in 2019. We didn't see that many people let go in 2019. You could see a little bit of a dip, right? And then just kind of taking off. And right now we're just flattening out, right? And many firms that are letting people go, unfortunately, are just right sizing, right? And so we know the tech sector, along with finance and retail, those are kind of like the pandemic darlings, as everyone was focused on those in terms of demand. Now the demand is cooling off, and you need to right size. But the thing is that, like, most people are probably going to keep their jobs, right? And that, again, announcements aren't reality. And those announcements sometimes are global, right? It's not all in the US necessarily. And when we look at some regional statistics, we have non-farm payrolls, or how many people are working in information. This Washington is still outperforming other big tech hubs like California and New York, right? And even when we look in this particular, the counties in and around where we are right now, you can see that you recovered from the pandemic, and there's some slowing, but it's not that bad, right? So let's keep our fingers crossed there. In terms of, I think I have one, maybe two more slides, activities that CEOs are focused on in the face of recession. What is it? It's accelerating innovation and digital transformation. It's in the top one or two, both for the US, Japan, and China. That's great for this region. That's fantastic, right? And in terms of what are they doing to ensure growth over the next 2-3 years, they are actually adding headcount in the US. They're upskilling and retraining existing talent. So companies are still looking to invest in their people, but they're still looking at digital transformation, right? So that's, and also automation. So that's in the top 5 for all of these regions here. So that's really great news for the future of this area. And if you want to think about what's so important in terms of driving growth going forward, you can see that we have a labor quality and quantity contributions to GDP growth over the next 10 years shrinking, but capital and productivity, which is TFP, are huge. And in order to grow productivity, you need to invest, right, in technology, in things like AI and 5G. I don't know what 5G is, but it works, right? I have it on my phone. I'm sure all of you do too. But, ChatGPT, oh my gosh, right? Sorry, I hope that's not a competitor's thing. But investments in infrastructure, in technology, in automation, all those things are key for making that light blue bar big over the next decade. And so that's a huge win for this group. And indeed, when you think about labor shortages, for those of you who might be thinking, oh my gosh, I'm next, or this isn't good, here we have our expectations of which occupations will be the most at risk for labor shortages, meaning there aren't going to be enough people, so that's where you should go, right? And most tech occupations have a risk of 50% or more, meaning people are really going to want you, right? So that's great news for this sector. And then that's it. Thanks so much.